The 5 harmless financial secrets seniors keep that explode into family drama and cost $100,000 in care. The harmless financial secrets you're keeping can explode into family drama and wipe out hundreds of thousands in care money. Verbal promises, helping a child, or we'll fix it later, aren't kindness, they're legal and tax traps. In this video, I'll show you the 5 secrets to stop hiding, what to do instead, and the exact next steps. You'll see the joint account landmine, the helpful child mess, and the silent power of attorney gap that can cost fortunes. These are real patterns from elder law, care finance, and caregiver disputes that I see every week. If you want fewer fights and more money for care, start here with the secret that ruins relationships before money even moves. Secret 1. The quiet joint account that blows up everything. If you've ever added a child to your bank account just to help, this is the quiet landmine that blows up more families than almost anything else. People do it to avoid probate or to make bill paying easier. But here's the thing most people miss. A joint owner isn't a helper. They're a legal owner. That exposes your money to their world, creditors, lawsuits, divorce, even benefit clawbacks. And when you pass away, survivorship rules typically push every last dollar to that joint owner, overriding what your will says. That's how siblings get disinherited by accident. Why this matters is simple. You think you're solving a paperwork problem, but you're creating a control problem, a fairness problem, and sometimes a tax and benefits problem. If your child gets sued, their creditors can target your joint account. If they divorce, your money can become part of the negotiation. If they receive needs-based benefits, your shared funds can complicate eligibility. I've seen quiet joint accounts trigger frozen funds at the worst possible moment, right when a care facility deposit is due. The thing most people miss is survivorship. Your will might say split everything equally, but a joint account with rights of survivorship typically goes 100% to the surviving co-owner. That bypasses probate entirely. Sounds efficient, but it can be devastating. The sibling who's listed as joint owner inherits the entire account, and the others get nothing unless that sibling decides to share. That's not a plan, that's a powder keg. And yes, even if everyone promised to be fair, memories get fuzzy and spouses have opinions. Courts see survivorship, not kitchen table promises. There's a better way that keeps your money safe and your family sane. Use POD or TOD designations, payable on death for bank accounts and transfer on death for brokerage accounts. Those pass assets directly to your named beneficiaries without probate, while keeping full control in your hands during your lifetime. If you want a child to help with bills, ask the bank for agent or convenience signer status, or set them up with read-only online access. Then use automated bill pay for predictable expenses. This gives you efficiency without handing over ownership. Let me show you exactly how to fix this. First, audit every bank, credit union, and brokerage account. Make a list. Who are the current owners, what's the title, and who are the beneficiaries. If you see an adult child listed as a joint owner and that wasn't your conscious estate plan, go to the bank and remove unintended joint owners. Next, add or update POD/TOD beneficiaries, primary and contingent. If you care about equal distribution, name beneficiaries by percentage, not dollar amounts, so it scales with account changes. Now, lock down access properly. Ask the bank for the right form to add an agent or authorized signer without survivorship rights. If your bank doesn't offer that, consider moving to one that does, or use a durable financial power of attorney that institutions will accept. Set up online, read-only access for your helper child so they can monitor but not move money. Turn on activity alerts, text or email to catch unusual transactions fast. And enable two-factor authentication. Those small steps stop identity mishaps and withdrawals. Here's the paperwork checklist so you don't miss anything. Account title confirmation letter, pod/TOD beneficiary forms with copies saved, agent/authorized signer form, durable POA on file that the bank has reviewed, online access permission screenshot, and alert settings. After any update, call the bank a week later to confirm changes are in their system. Don't trust that a form went through until someone reads back the settings to you. And keep a simple one-page summary in your family binder stating account, institution, beneficiaries who has access, and where the POA is stored. Let me give you a quick micro story I've seen versions of many times. A widowed mom added her oldest daughter to her checking just to help with bills. Moms will set split everything 3 ways. Mom passed. The account had $180,000. By survivorship, the entire $180,000 became legally the daughter's. The other 2 siblings expected a third. The daughter offered to even it out later, but her spouse said, "That money is legally ours." Lawsuit. Relationships shattered. To make matters worse, the daughter had a business hiccup, and a creditor froze the account during probate questions. The result? The family had to front private pay care costs during the dispute, while Medicaid planning was delayed by the 5-year look-back concerns around transfers from that joint account. All of it was preventable. Now here's what most people ask. Can't I just trust my child? Trust is great. Systems are better. Pod/TOD keeps your intent clean and your money protected from someone else's risks. A POA lets them help when needed without changing ownership. An automatic bill pay removes the need for constant transfers. If you remember nothing else, remember this. Helpers need authority, not ownership. Common mistakes to avoid. Don't add a child to an investment account to avoid paperwork. Don't let a helpful adult child move money between your accounts from their login. Don't assume the bank's standard joint setup matches your intent. Always ask if it includes survivorship. Don't forget contingents. If a beneficiary predeceases you want persterpes or named contingents to keep your plan from collapsing. And don't leave stale joint titles on small CDs or savings accounts. Those tiny accounts create outsized fights. A quick win you can do today. Print your account list and circle any with joint owners. Schedule a 20-minute call with the bank to learn their process for removing joint owners and adding pod. While you're at it, ask how to add alerts and read-only access. Then write a simple note. I use pod/TOD for estate transfer. No family member is a joint owner. Keep that in your binder, so no one fixes your plan later with a casual title change. The reason this works is simple. You're separating 3 roles that get dangerously blurred: ownership, oversight, and assistance. Ownership stays with you. Oversight is read-only or alerts. Assistance comes from POA or authorized signer authority. When you keep those lanes separate, you avoid the creditor exposure, the disinheritance risk, and the sibling resentment that joint accounts create. If joint accounts are landmines, verbal promises are quicksand. That's where families sink while saying, "We'll work it out later." Let's fix that next. Secret 2, verbal promises and deals no one wrote down. Verbal promises feel kind. They're quick, friendly, and they avoid awkward paperwork. But when money or heirlooms are involved, spoken agreements are quicksand. They pull everyone under exactly when emotions run hottest, after a crisis or after a death. The pattern is predictable. Different memories, shifting stories, and no paper trail. Mom said I could have it turns into a permanent grudge, and the person everyone loved becomes the center of a fight they never wanted. Why this matters is simple. Verbal deals have no timing, no terms, and no proof. Even good people misremember. Add grief and stress, and tiny misunderstandings become accusations. I've seen a loan to help a child through a rough patch become, that was a gift years later. The difference? No note, no schedule, no receipts. And here's the punchline. Those fuzzy arrangements can also mess with benefits and taxes. If you plan to qualify for Medicaid later, undocumented transfers can look like gifts and trigger a penalty during the look-back review. That's not just drama, that's real money lost and care delayed. The thing most people miss is how fast small items cause big wars. Heirlooms, grandma's ring, dad's tools, the dining table carry memories, not just value. Without a signed distribution list, siblings hear what they want to hear. One remembers, "She promised the ring to me when I turned 40. Another remembers, "She said the first granddaughter gets it." Both are sincere, both can't be right. Furniture, art, and even photo albums create the same mess. And when cash changes hands with a verbal, "I'll pay you back after probate," you've set up a boomerang argument that hits precisely when people are raw. There's a better method. Write it down every time using simple tools. For gifts, use a gift memo. What, to whom, approximate value, date, and your signature. For loans, use a plain one-page promissory note with an amount, interest rate, if any, a repayment schedule, and a due-on-death statement, so your executor can collect or forgive per your instructions. For heirlooms and household items, create a signed distribution list and attach photos. If you already have a will or trust, ask your attorney about a separate personal property memorandum many states allow. It lets you update items without redoing the whole document. Let me show you exactly how to fix this starting today. First, list every undocumented promise you've made or hinted at: cash, loans, the car you said a grandchild could have, the piano, the gun safe, the sewing machine. Second, decide, is it a gift or a loan? Gifts are one way. Loans require terms and tracking. Third, capture it in writing. If it's a gift, write a memo and give a copy to the recipient and your executor. If it's a loan, draft a note, sign it, and ask the borrower to sign too. Then create a simple ledger on paper or a spreadsheet recording payments and dates. Now, build a receipt habit. Any transfer, cash, Zelle, check, gets a note in the memo line and a screenshot saved. Title your files the same way every time. February 10th, 2025 gift to Sam, $500 for travel. Those 10 seconds save 10 months of arguments. If you're repaid for a loan, deposit by check or online transfer with loan payment in the memo so the trail is obvious. And if you decide to forgive a balance, write a brief forgiveness note and date it. Your executor and your heirs will thank you. Here are practical scripts that make this painless. When a child asks for help, happy to help. I'll put that in writing so no one gets blamed later. When someone claims an heirloom, I'll document that now and add it to my property memo so it's clear. When a relative says, "We don't need paperwork," I've seen too many families fight. The paper protects the relationship. Keep it calm, routine, and matter of fact. Paperwork is your boundary, not a judgment. Watch out for pitfalls that look harmless. Interest-free family loans can be fine, but zero interest with no schedule turns into whenever, and whenever becomes never. If you want zero interest, still set a due date and a minimum monthly payment. Unclear co-ownership is another trap. "You can use my car" isn't the same as "your name is on the title." If two names end up on a title without intent, you may have created a gift and changed liability and insurance. And the big one, "I'll pay you back after probate." That phrase is a time bomb. If repayment depends on an estate with unknown timing and legal costs, someone will feel cheated. A quick story I've seen play out. A son borrowed $25,000 for a home down payment. No note, just a text, "Thanks, Mom." Years later, Mom passes. The will says, "Equal shares." One sibling says, "We need to net that $25,000 against his share." The borrower says, "That was a gift." There's outrage, old resentments, and legal fees. Meanwhile, the estate needs cash to hold a care facility bed, while benefits are sorted, and the family argues instead of acting. If mom had a one-page note or a gift memo, it would be settled in minutes. Here's the shortcut nobody teaches. Pair every promise with either a document or a dollar. If you don't want to formalize it, don't do it. If you do it, formalize it. That one rule keeps your generosity from becoming a grievance file. And tie it into your broader plan. Update your executor instructions to reference where gift memos and loan notes are stored. Tell your POA where to find the ledger so they can answer questions without guessing. Before we move on, let me give you a now you try moment. Pick one verbal promise that still lives in your head. Write a 2-sentence memo. On date, I promised item or amount to name. This is a gift/loan. If a loan, the repayment is terms. Signed. Put a copy in your binder and send a photo to the recipient with "just keeping us tidy." That tiny action removes a future fight. The reason this works is trust plus clarity beats trust alone. You're not replacing love with legalese. You're protecting love from the fog of memory, from grief, and from spouses and in-laws who weren't at the kitchen table when you made that promise. Paper stops stories from changing. And when benefits or taxes enter the picture, documentation proves intent. Gift versus compensation. Personal loan versus estate adjustment. And that matters for eligibility and timing. If joint accounts are landmines and verbal promises are quicksand, the next trap is disguised as love, paying for one child in a way that quietly wrecks care eligibility. Let's fix that before it costs a fortune. Secret 3. Paying for one child and accidentally torpedoing care plans. This one looks like love. You step in to help a child with tuition, a down payment, or just until they get back on their feet. The hidden cost? Those support gifts drain your care reserves and can trigger Medicaid look-back penalties that delay eligibility and force expensive private pay. I've seen families lose 6 figures simply because a kind gesture was treated as a gift instead of documented compensation or a planned, affordable expense. The thing most people miss is the line between a gift and payment for services. Medicaid doesn't care that your son helps around the house if you hand him cash without a caregiver agreement and records. To the caseworker, unexplained transfers look like gifts. During the look-back period, commonly 5 years for nursing home. Medicaid, gifts create a penalty period where you're ineligible. That gap has to be paid out of pocket, often at top of market rates. That's the moment generous parents discover their money is gone, and the facility wants a deposit now. There's also confusion around room and board. If an adult child moves in and you cover their food, utilities, and gas, those payments can look like gifts if you don't spell out the arrangement. The caregiver child trap shows up when a helpful kid provides real care, but the family never formalizes it. Later, everyone says, but they earned that money. Without a written agreement, time logs, and payments at or below market rates, Medicaid treats it as gifting. Intent isn't enough. Documentation wins. Here's the better method. Convert help into a legitimate caregiving relationship with paper. Use a written caregiver agreement that includes duties, hours, market rate pay, mileage if applicable, and how you'll track time. Pay by check or transfer with caregiving services in the memo. Keep weekly timesheets and invoices signed by both of you. Withhold and remit payroll taxes, or issue a 1099 if appropriate. Talk to a CPA to choose the right path. When you show a caseworker a clean contract plus logs and tax forms, you've got evidence that those payments were compensation, not gifts. If you're supporting a child for non-care reasons, set allowance rules and caps. Decide a monthly maximum you can actually afford, how long it lasts, and what triggers a review. Tie it to your care runway. How many months of care you can self-fund. A simple model. List your current assets earmarked for care subtract a conservative emergency cushion, then divide by your projected monthly burn rate. That burn includes housing, meds, insurance, caregivers, and a buffer for surprises. Aim to maintain a 12 to 24-month runway. If support threatens that cushion, scale back or pause. Let's make it practical. Fix this now by doing 3 things. First, stop undocumented gifts. No more quick transfers. Second, if a child is providing care, rides, meals, bathing, medication reminders, convert it to a contract this week. Download a caregiver agreement template from a credible elder law source or get one from an elder law attorney to ensure state compliance. Third, set a monthly money meeting with yourself or your POA. Review outflows to family, compare to your runway, and adjust. Watch the compensation details. Pay at or below local market rates for similar services. Call a home care agency for their hourly rate to benchmark. Avoid big lump sums. They look like gifts. Do hourly or flat weekly payments linked to logged duties. Keep a calendar and a simple timesheet. Date, tasks start/end times, total hours, signature. Store it in your binder and digital vault. And if you ever need Medicaid, those records are gold. Here's a micro story that happens more than you'd think. A grandmother pays a $30,000 college tuition for a grandson. No note, just love. 2 years later, her health shifts. She needs long-term care and applies for Medicaid. The caseworker flags the tuition as a gift within the look-back. Result? A penalty period based on local rates. The facility requires private pay to hold a bed. The family scrambles, sells investments at a bad time, and covers months of care at premium prices. That harmless tuition snowballs into a 6-figure private pay gap and delayed placement in the right community. Now, you might be thinking, what if my child really is sacrificing a job to care for me? Then pay fairly on paper and consider respite coverage so they don't burn out. Also, assess whether you're better off hiring part-time agency help. An agency brings backup caregivers, liability coverage, and clean payroll records, often making Medicaid scrutiny easier later. A hybrid model works well. Family handles companionship and errands. Paid caregivers handle personal care and heavy tasks. Taxes matter here too. If you pay a family caregiver under the table, you create risk. A sudden 1099 at the wrong time can push their taxes or benefits into chaos, and it can also complicate your deductions. Some families can use medical expense deductions if a doctor prescribes care. Talk to a CPA about bunching qualified expenses into one tax year or using a health savings account if eligible. Don't improvise this. A 30-minute CPA consult can prevent a costly mistake. Before we go further, let's build your care runway. Grab a notepad. Write down monthly housing costs, utilities, food, meds, premiums, transportation, and any current caregiver hours. Add a contingency line, at least 15%, for surprises. Total it. Now, list your liquid assets: cash, brokerage, safe-to-sell investments. Exclude money you must keep for peace of mind. Divide the liquid amount by your monthly total. If that number is under 12, you can't afford open-ended family support. If it's 12 to 24, be cautious and document everything. Over 24, you have more flexibility, but still, use agreements. Common mistakes to avoid: paying a child's rent directly without a written purpose, inconsistent transfers that spike right before a Medicaid application, calling care, helping out while also paying cash, giving a lump sum thank you at move-in to assisted living, and confusing caregiver pay with inheritance. Inheritance is later through your estate plan. Today's care is a job. Keep them separate. A quick win today: write a 1-page caregiver agreement and start a timesheet. Even if you backfill last month's hours, document them now. Rename your payment memos to caregiving going forward. If you've made support gifts in the last few years, create a transfer log with dates, amounts, recipients, and purpose. If Medicaid might be in your future, Take that log to an elder law attorney to map options. Some states allow partial cures or strategies that reduce penalties. Don't guess, get advice. Here's the shortcut. Generosity needs guardrails. Contracts, logs, market rates, and taxes turn help into legitimate care that protects eligibility. Allowances need caps tied to your runway. And big non-care gifts should wait until your own care plan is fully funded. If you remember nothing else, remember this line. Loving a child today shouldn't cost you a safe bed tomorrow. Speaking of eligibility, there's one document gap that quietly drains time and cash when health changes. If help needs to happen this week and no one has authority, costs explode. Let's fix the power of attorney problem next. No power of attorney or outdated ones. This is the silent money drain. You feel fine today, so the POA can wait. Then a fall, a stroke, or even a short hospital stay hits, and nobody has legal authority to act. Bills stall, accounts freeze, admissions get delayed, and the family is pushed toward court-ordered guardianship. That process eats time, cash, and sanity. I've seen families waste months and thousands in legal fees because a simple document wasn't current and accepted. Here's why this matters. Without a valid financial power of attorney, your adult children can't access your accounts, negotiate with insurers, sign facility contracts, or move funds to protect eligibility. Without a healthcare POA, they can't consent to treatment, coordinate discharge, or authorize care. People confuse "I'm on the account" with authority. Banks and hospitals need legal documents, not just good intentions. And when the clock is ticking on a facility bed, every day of delay is real money. The thing most people miss is that POAs aren't all the same. You need two categories, financial and healthcare. Each state has its own preferred language. A springing POA only activates after you're deemed incapacitated, which sounds safe but creates delays while you chase doctor letters. A durable POA is active the day you sign and survives incapacity, which means your helper can act immediately when you need them. Many banks quietly reject older POAs or out-of-state forms. Some even insist on their own internal POA addendum. If you don't confirm acceptance in advance, you'll learn the hard way at the worst moment. So, what's the better method? Keep current, durable POAs. One for finances, one for healthcare, with clear powers, backups, and state-compliant language. Include HIPAA authorization, so your agents can access medical information. Pair the healthcare POA with an advanced directive or living will to spell out your wishes around life support, pain control, and end-of-life care. For finances, make sure the powers include modern items like digital assets, tax matters, retirement account transactions, beneficiary updates where allowed, safe deposit box access, and the authority to contract for care. Let me show you exactly how to fix this. First, pull your existing POAs. Check the date, state, and names. If it's more than 5 to 7 years old, created in another state, or names someone who's moved, ill, or not the right fit, it's time to update. Second, meet with an elder law attorney to draft state-specific, durable POAs and related documents. Ask them to include broad powers commonly required by banks, plus explicit HIPAA language. Third, choose agents and backups. Pick people who are organized, calm under pressure, and geographically reachable. It's okay to split roles. One child for money, another for health. You can even name a non-family fiduciary if that reduces conflict. Now, the acceptance step. This is where most families fail. After you sign, call every institution, banks, credit unions, investment firms, insurance companies, and your safe deposit location. Ask if they accept outside POAs and whether they need their internal forms. If they do, complete those now while you're healthy and present. Upload copies to each portal where possible. For healthcare, give copies to your primary doctor, cardiologist, or neurologist if applicable, and your preferred hospital. Attach your HIPAA release an advance directive. Don't stop at "we have it on file." Ask them to note the agent's contact in your chart. Here are decision rules to reduce conflict. Avoid co-agents who must act together. Requiring 2 signatures slows everything. If you want oversight, name one primary agent and a backup, or allow either co-agent to act independently with a requirement they keep the other informed. If siblings don't get along, separate duties. One manages money, the other handles health. Put that structure in writing and tell everyone. Your line can be, "I'm choosing roles to match strengths so things run smoothly." Storage and sharing matter. Keep originals where you can reach them, your binder and a fireproof location at home. Put PDFs in a secure digital vault with a simple file path your agents can access. Share who is agent, where the documents are, and a 1-page summary of your wishes. Include a wallet card or phone note that says, "In emergency, call my health agent," with the number. If you use a safe deposit box, add your agent to the access card or include clear authority in the POA, and make sure a key is available. Let me give you a fast micro story. A daughter tried to admit her mom to assisted living after a sudden decline. The community asked for a deposit and a signed residency agreement within 48 hours to hold the room. Mom's POA was a 12-year-old springing form from another state. The bank wouldn't honor it without incapacity letters, and the facility wanted a signer now. Assets were frozen for verification. The deposit window closed, and the family lost the room. They paid for 2 weeks of respite out of pocket while rushing guardianship. Legal fees and bridge care costs stacked up into 5 figures before mom even moved in. A current, durable POA plus bank pre-acceptance would have avoided all of it. Common mistakes to avoid: relying on a generic online POA that lacks state language, naming someone because they're oldest instead of because they're capable, hiding the documents so no one can find them, assuming a healthcare POA equals a living will, and forgetting HIPAA. Another big one, never testing acceptance. If your agent can't get through a bank's POA department in normal times, they won't during a crisis. Quick wins you can do today. Text your likely agents. Are you willing to be my financial and/or healthcare agent? If I can act. If they hesitate, pick someone else. Next, put POA update on your calendar and book the elder law appointment. While you wait, create a 1-page emergency sheet. Agent names and numbers, doctors, medications, preferred hospital, and a note that POAs and HIPAA are in your binder and digital vault. Hand a copy to your agents. Now, test your system. With you present, call one bank and ask them to annotate your account with your agent's info and confirm POA acceptance steps. Do the same with your doctor's office. Please add my healthcare agent and HIPAA release to my chart. You're not waiting for a crisis to find the gaps. You're closing them today. If you remember nothing else, remember this: documents only work if the right people have them and institutions accept them. Durable, current, state-compliant POAs with backups, plus HIPAA and a living will turn chaos into a checklist. And when care decisions and money movement need to happen this week, you'll move fast without the court, without the fees, and without the family meltdown. Documents are good. Beneficiary designations are faster. Let's tighten those next. Hidden or wrong beneficiaries and titles. This one looks harmless because the paperwork sits quietly for years. But hidden or wrong beneficiaries and sloppy titles are the fastest way to undo your entire plan in one move. Here's the thing most people miss: beneficiary designations override your will. If your IRA, life insurance, or brokerage TOD still lists an ex-spouse or a deceased child, that money bypasses your estate and goes exactly where the form says. Courts don't fix outdated paperwork. They follow it. Why this matters is simple. You might have the best written will on earth, but if the beneficiary on your retirement account is wrong, your heirs won't see a penny from that asset. And it's not just retirement. Banks use POD, payable on death forms. Brokerage accounts can use TOD, transfer on death. Annuities and life insurance all use beneficiary forms. Those are contracts. They pay the named person, even if your will says otherwise. That's how estates get drained, siblings sue, and care funds vanish in legal fees. The thing people miss next is structure. Per stirpes versus per capita. Per stirpes means a deceased child's share passes down to their children. Per capita means shares get redivided among surviving beneficiaries. If you intend grandkids to inherit a parent's share, you need per stirpes or named contingents aligned with that goal. Many forms default to per capita or have no default at all. If a beneficiary dies and there's no contingent, the asset may end up in probate, slow, public, and expensive. Here's the better method to lock this down. Do an annual beneficiary review and align everything with your will or trust. On each account or policy, you want primary beneficiaries and contingent beneficiaries clearly listed. Use percentages, not dollar amounts, so your plan scales with market changes. Avoid naming minors directly. If a minor inherits, a court may need to appoint a guardian to control the money until adulthood. A cleaner approach is naming a trust for minor beneficiaries, or, at minimum, an adult custodian under your state's UTMA on non-retirement assets. For retirement accounts, coordinate with an attorney so you don't accidentally create costly tax treatment. Fix it now with a simple pull and update routine. Step 1. Pull every policy and account. IRAs for 401k, S for 403b, S, pensions if applicable, life insurance, annuities, brokerage accounts with TOD, bank accounts with POD, HSAs, and even credit union shares. Step 2. Print or download the current beneficiary page. Don't guess, confirm what's on file. Step 3. Update primary and contingent beneficiaries. Choose per stirpes if that matches your intent, and submit the forms. Step 4. Confirm receipt and system update with the institution. Ask for written confirmation or a screenshot from the portal. Save it to your binder and digital vault. Now let's talk title traps, the sneaky ways ownership gets in the way. A house in a single name with no transfer plan can freeze at death, delaying sales or refinancing right when cash is needed for care or final expenses. In some states, you can add a transfer on death deed to pass real estate without probate if it fits your plan. Car titles can also stall transfers. Some states allow TOD designations for vehicles. CDs without TOD often land in probate. A small CD can cause big headaches, locking funds while bills pile up. What about ex-spouses and old beneficiaries? It happens constantly. People forget to update after divorce, death, or a family change. Life insurance pays the ex. The current spouse finds out after the check is cut. Siblings sue, the estate bleeds, and the money you meant for care has gone to attorneys. Don't rely on, the divorce decree said, institutions pay the named beneficiary unless a court order specifically changes the contract and is on file. Update the form. That's the fix. Here's the paperwork checklist to keep you organized. For each account or policy, keep current beneficiary printout, the date you last updated, primary and contingent names with percentages, per stirpes election if used, and confirmation of acceptance. For titles, copy of deed with the exact vesting, notes on whether a TOD deed is in place, car title copies, and any TOD or beneficiary language. For each bank or brokerage, POD/TOD forms, date submitted, and confirmation. Store the whole packet in your binder and upload to your secure vault. A quick microstory that hurts to hear. Dad had a $250,000 life insurance policy from his employer. He divorced 20 years ago, remarried, and never changed the beneficiary. When he passed, the policy paid the ex as the form required. The new spouse and kids assumed the will would control. It didn't. They sued, spent a year and tens of thousands in legal fees, and still lost because the contract ruled. The result: the estate's cash was drained, the surviving spouse struggled with housing costs, and the family postponed care choices they'd planned. One missed form reshaped a decade of finances. Let's avoid that. Common mistakes to watch for: listing my estate as beneficiary for retirement accounts, which can cause tax complications and delays; forgetting contingents entirely; naming one child to split later and assuming they will; leaving a deceased person on the form and assuming it simply flows to the others; and naming minors directly. Another big one is mismatching your will and beneficiary forms. Your will says equal shares, but your IRA still points to only one child. That's a guaranteed fight. Now a quick win. Start a 30-minute beneficiary sprint. Pick one category. Say, retirement accounts. Log in, download the current beneficiary page, and print or save it. If anything's wrong, submit the update today. Then send yourself a calendar reminder. Same time next week for life insurance and annuities. The week after that, do bank and brokerage TOD/pod. 3 sprints, you're done. Add a repeating annual reminder titled Beneficiary and Title Review. No excuses. For families with trusts, make sure titled assets and beneficiary designations coordinate with the trust's plan. Some assets should list the trust as beneficiary. Others should list family directly. This is not one size fits all. Check with your attorney and your tax pro so you don't turn a tax-smart account into a tax headache. If you remember nothing else, remember this: your will is not a mop that cleans up bad forms. Beneficiary designations and titles are the steering wheel. Point them where you actually want the money to go. Do annual reviews, add contingents. Use per stirpes when intended, avoid minors, and confirm every change is in the system. Even with clean titles, taxes and timing can still eat your plan. So next, let's fix the order you pull money from before the IRS and surcharges shrink your care funds. The tax timing mistake: cashing the wrong accounts first. Taxes quietly eat care money. And the order you pull cash from matters more than most people realize. The mistake I see all the time is paying big expenses from the most tax-painful account, usually a traditional IRA, when a smarter sequence would have saved thousands and avoided Medicare surcharges that cut monthly income for 2 years. Let me show you the better order and how to apply it without a spreadsheet headache. Why this matters: withdrawals can push you into a higher tax bracket, make more of your Social Security taxable, and trigger IRMAA, those income-related surcharges on Medicare Part B and Part D. IRMAA is based on your tax return from 2 years ago, so one big pull today can raise your premiums for 2 full years, reducing cash you need for care. It's not just the tax, it's the ripple effect on your monthly budget. Here's the basic framework most tax pros use as a starting point, adjusted to your situation. Generally spend from taxable accounts first: regular brokerage with stocks and funds, then traditional IRAs and 401(k)s to fill up lower tax brackets and save Roth accounts for. Last, why? Taxable accounts often have favorable capital gains rates and a step up in basis at death, which can make holding winners efficient. Traditional IRAs are taxed as ordinary income, so you want to manage them intentionally, not in lumpy emergencies. Roths grow tax-free and can be powerful reserves later. But there's more nuance. You may need to take required minimum distributions from traditional retirement accounts once they begin. Don't ignore RMDs. If you must take them, integrate them into your plan so you're not stacking extra taxable income on top of the RMD at year-end. And when you need cash for a roof repair, medical equipment, or a community entrance fee, stop before pulling from an IRA. Ask, can I raise cash inside my taxable account with minimal gains? Can I split this over 2 tax years? Can I temporarily use a home equity line and repay in January to spread income? Let's make it practical. Build a simple bracket map. Step 1. Know your current taxable income estimate for the year, Social Security, pensions, dividends, interest, and RMDs. Step 2, look up your next tax bracket breakpoint. Step 3, decide how much IRA money you can withdraw while staying under that breakpoint. If you need more cash beyond that, look to taxable accounts or consider timing the expense across calendar years. This is bracket management, filling lower brackets on purpose while avoiding jumps. Now, the Social Security tax trap. Up to 85% of Social Security can become taxable depending on your other income. Large IRA withdrawals can tip you over those thresholds, effectively increasing the tax cost of the withdrawal. The fix is planning smaller, steady IRA distributions throughout the year instead of one big hit, and pairing charitable giving with qualified charitable distributions. If you're eligible, a QCD lets you give directly from your IRA to a qualified charity, counts toward your RMD, and keeps that amount out of your adjusted gross income, which can help with IRMAA too. If you're charitably inclined, QCDs are a clean win. Capital gains deserve intention as well. In taxable accounts, you can harvest gains or losses on purpose. Selling a holding with a loss can offset gains elsewhere. If you're in a lower bracket, you might even realize some long-term gains at a % capital gains rate if the math lines up. The point is to harvest intentionally, not accidentally. Review unrealized gains and losses before year-end and rebalance with taxes in mind. Here's a micro story. A homeowner needed $18,000 for a new roof. Their advisor was out of town, so they pulled it from a traditional IRA because that's where the cash was. That pushed their modified adjusted gross income over an IRMAA threshold. 2 years of higher Medicare premiums followed, reducing monthly cash flow right when care costs were rising. If they had raised cash from their taxable account first, or split the expense in December and January, or used a small home equity draw and repaid with planned IRA withdrawals inside the lower bracket, they likely would have avoided the surcharge. Let me give you a checklist you can use before any big expense. What's my current year income estimate, including RMDs? If I withdraw from my IRA, which bracket will I hit? Will this increase how much of my Social Security is taxed? Will this push me over an IRMAA bracket 2 years from now? Can I raise cash from taxable assets with minimal gains? Can I split the expense across calendar years? If I'm giving to charity, can a QCD cover part of this and reduce AGI? Withholding matters too. If you do take IRA distributions, set appropriate tax withholding on the distribution, so you're not slammed with a surprise payment next April. It's often better to withhold on the IRA distribution itself than to make separate estimated payments, because withholding is treated as if it happened evenly all year. That can help if you're late in the year. A CPA/CFP planning session is a high ROI move here. In 1 hour, you can map withdrawal order, decide how much IRA to take this year versus next, plan QCDs if applicable, and set IRMAA guardrails. Ask for a tax-smart drawdown plan that covers taxable first, then strategic IRA withdrawals. And Roth last, unless your CPA recommends earlier Roth use for a specific reason, like keeping future IRMAA low or coordinating with survivor tax brackets. Here's a quick win you can do today. Pull your latest Social Security benefit, last year's tax return, and current account balances. Write 3 numbers, your projected income, your next bracket cutoff, and the nearest IRMAA threshold above your projection. Post those in your binder. Before any withdrawal, glance at those numbers. If the withdrawal crosses a line, pause and call your CPA. Common mistakes to avoid: paying large one-time bills directly from IRAs late in the year, forgetting that mutual funds in taxable accounts can distribute capital gains in December, selling winners without, checking tax lots, ignoring RMD timing, skipping withholdings, and then facing penalties, and assuming Roth is always last. Sometimes strategic Roth withdrawals reduce future IRMAA and survivor taxes. If you remember nothing else, remember this. Order and timing turn the same dollars into more care. Manage brackets, protect Social Security from unnecessary taxation, and stay under IRMAA cliffs. Use taxable first when it makes sense, fill IRA distributions thoughtfully, and reserve Roth as your flexible safety valve. Now, let's tackle the estate plan that sounds fair, but quietly wrecks families. The equal is fair estate plan that backfires. Equal sounds fair, but in real families, it often lands like a verdict. You write, split everything 3 ways, and think you prevented fights. But equal on paper can be deeply unfair in practice, especially when one child has sacrificed years of time, income, and health to be the day-to-day caregiver. That mismatch breeds resentment, challenges, and the kind of long grudges that spill into holidays and hospice decisions. Why this matters: when contributions are unequal, equal distribution feels like erasing the work. The caregiving child sees siblings flying in twice a year while they do meds, meals, and midnight falls. Equal splits also ignore special needs dependents, housing equity distortions, and debts or loans that were really gifts. Add in step-families, exes, and in-laws, and an equal plan can light the fuse before probate even starts. The result: delays, legal costs, and money that should cover care evaporates in conflict. The thing most people miss is that equal assumes equal inputs and equal impacts. They rarely are. The house is the clearest example. One child has lived nearby for years, handling repairs and coordinating contractors. Another lives out of state. If your will simply gives each a third of the home's value, expect disagreements on price, timing, and who pays to prep it for sale. If one wants to buy out the others without rules, you've set up a fight over appraisals and discounts for sweat equity. Meanwhile, property taxes and insurance keep burning cash. There's a better method: design fairness, not default equality, that can look like caregiver stipends during life, specific bequests to account for sacrifices, and a letter of intent explaining your reasoning. A letter of intent isn't legally binding, but it's powerful context that reduces blame and confusion. For households with a special needs child or grandchild, equality can actually harm benefits. You may need a supplemental needs trust for their share and different instructions entirely. Equal is fair ignores those realities. Let me show you how to implement a fairness-first plan. Start by valuing caregiver time. If a child is or was providing regular care, estimate hours, and compare to a local agency's rate. If you can pay during life, use a caregiver agreement and pay at market rates with invoices and taxes handled. If paying now isn't possible, consider a specific bequest in your estate plan. $X to my caregiver child. Then the residue split equally. That acknowledges the contribution without forcing siblings to be generous later, which rarely works once spouses weigh in. Next, deal with sentimental items directly. Don't leave it to you all decide. Create a personal property memorandum with itemized gifts, attach photos. Rotate pics with a clear order if you prefer that system, but write it down. Small items carry big feelings. The more you specify, the less your executor has to referee. For collections, tools, firearms, or art, add instructions on sale versus keep, and any rules for who buys at what price. Now, fix the house problem before it becomes a war. If one child wants to buy the home, set buyout rules now. Independent appraiser selection process, a time window to decide, required financing deadlines, and who covers carrying costs during the process. If no buyout within that window, house goes to sale with the executor empowered to choose the agent, list price range, and acceptable discount for as-is condition. Add a holdback for repairs and staged funds, so the executor isn't begging siblings for cash. If co-ownership is unavoidable, define the operating agreement like a business, who manages expense sharing, decision thresholds, exit options, and a dispute mechanism. But here's the truth. Most siblings can't co-own peacefully for long. If your heart says keep the house in the family, your plan needs money for maintenance, a manager, and a roadmap. Otherwise, you're handing them a headache with shingles. Address unequal contributions during life. If you helped one child with a big down payment or tuition, decide whether that counts against their inheritance. If yes, say so and document the amount and date. If not, say that too. Don't leave room for, well, everyone knows, because in probate, everyone suddenly remembers differently. Your executor needs clear math and a page to point to. Here's a practical communication script that reduces defensiveness. I'm documenting choices to prevent blame later. This isn't about who I love, it's about matching gifts to needs and contributions so no one is stuck fighting after I'm gone. That line lowers the temperature and frames your decisions as protection, not punishment. A micro story I've seen repeat. A daughter leaves her job to care for mom 2 years. She loses wages and retirement contributions, puts her life on hold, and keeps mom at home longer, which saves the family money. Mom's will says equal, shares. After mom passes, the daughter asks for recognition of care. Siblings say, we're grateful, but the will says equal. The caregiver feels used, resentment spills out, and suddenly every minor expense becomes a point of principle. Meanwhile, paperwork stalls, facility refunds, and insurance claims wait, while siblings argue, and late fees nibble the estate. A simple caregiver stipend during life, or a specific bequest plus a letter of intent, would have honored the work and avoided the fight. Now, special needs. If a beneficiary gets needs-based benefits, an equal share outright can disqualify them or force spend-downs. The better route is a supplemental needs trust with a trustee who understands the rules, plus clear guidance on paying for quality-of-life items rather than cash. This is a prime case for an elder law attorney who understands both benefits and estate law. Common mistakes to avoid: promising the house to multiple kids to share, leaving business interests equal without a buy-sell plan, assuming stepchildren and biological children will sort it out fairly, writing vague language like distribute according to what's fair without definitions, and telling kids your plan in detail, then inviting debate you can't win. As the research on family dynamics shows, revealing estate specifics early often triggers comparisons, pressure, and years of tension. Share the structure. It's handled and documented, but not the line by line. Let's get tactical. Fix now. Meet with an elder law or estate planning attorney to add specific bequests, create a personal property memo, and set house buyout or sale rules. Add a letter of intent that explains caregiver recognition and any adjustments for prior large gifts. If you have a caregiver child today, either pay them under a written agreement or define how their contribution will be recognized. Update beneficiary designations to match these choices so contracts and the will don't collide. Here's your quick win. Write a one-page fairness note tonight. Bullet 3 decisions: caregiver recognition, house rules sentimental item process, and the why. Place it in your binder and email a PDF to your attorney. You can refine the legal language later, but you've set the direction now. If you remember nothing else, remember this: equal is a number, fair is a narrative backed by documents. Build the narrative, write the rules, and you'll protect both relationships and care money. And then make sure people can actually find the plan, because an invisible plan might as well not exist. The invisible plan, documents no one knows how to access. An invisible plan is a plan that fails at the exact moment you need it. You might have the perfect will, updated POAs, clean beneficiary forms, and careful notes. Yet if no one can find the actual documents, logins, or policy numbers within minutes, admissions get delayed, deposits can't be made, and opportunities disappear. Facilities won't hold a room based on, we're pretty sure there's a policy. They need names, numbers, and funds. Silence costs money. Why this matters is simple. Care is time sensitive. Hospital discharge planners Need the accepting facility confirmed today. Facilities often require a deposit or financial verification within 24 to 72 hours to hold a bed. If your family is tearing through drawers, guessing passwords, and trying to figure out which bank holds which account, they'll miss deadlines, pay out of pocket to bridge the gap, or lose access to a better, more affordable option. On top of that, policies can lapse because premiums weren't on autopay and benefits get missed because no one knew a policy existed. The thing most people miss is scope. It's not just legal documents. It's digital logins, two-factor authentication devices, safe deposit access, policy numbers, premium due dates, beneficiary confirmations, advisor contacts, care team contacts, and a ready path to move money fast. I've seen families who knew mom has long-term care insurance, but couldn't find the carrier or policy number. Result: the facility billed private pay while the family hunted. Weeks later, benefits started, but those first bills were theirs. There's a better method. A simple family binder paired with a secure digital vault, plus a clear access protocol. The binder is your offline brain. Originals or copies of POAs, HIPAA, living will or trust summary, beneficiary printouts, deed copies, car titles, insurance declarations, policy numbers, medication list, physicians, pharmacies, Medicare card, supplemental plan info, Social Security and pension details, and a one-page funds fast plan. The digital vault mirrors this: PDFs of every document, passwords stored in a password manager, and shared emergency access set up for your agents. Let me show you exactly how to build it. First, compile identification: driver's license, passport, Medicare card, insurance cards. Next, legal, financial POA, healthcare POA, HIPAA release, living, will or advance directive, will or trust summary sheet that states where originals are stored. Then financial, bank and brokerage account summaries, beneficiary confirmations, recent statements, and your funds fast sheet, where to pull a deposit within 24 hours. Add insurance, long-term care policy, life insurance, annuities, Medicare supplement, homeowners auto, include carrier, policy number, agent, premium autopay details, and claim phone numbers. Now add care. Medication list with dosages, allergies, primary and specialist contacts, preferred hospital, and current diagnoses that matter for care planning. Add home. Deed copy, any transfer on death deed. If used, utility list with account numbers and who to call to pause services if you're hospitalized. Add contacts: elder law attorney, CPA, financial advisor, insurance agent, care manager if you have one, and at least 2 backups who know where the binder lives. Digital is your second leg. Use a reputable password manager. Store logins for banks, brokerages, insurance portals, Social Security, Medicare, and healthcare systems. Turn on emergency access for your agents so they can unlock your vault if something happens. For two-factor authentication, list which phone or email receives codes. If you use an authenticator app, write down where it lives. If an old phone is the only way into your bank, you've created a single point of failure. Solve it now by adding your agent's number as a backup for critical institutions if policy allows. Access protocol is the secret step that makes this 10x easier. Write one page titled, "If I'm hospitalized or need admission." It should say who to call first, where the binder is, where the digital vault is, who is authorized to move money, which account funds a deposit, and a script to use with the facility. We can wire a deposit from bank account ending in hashtag today. Add a second page. If I pass away, it lists the same essentials with the executor's name and immediate tasks. Secure the house, notify insurers, and order multiple death certificates later. Clarity reduces panic. Now test your system with a 15-minute "where is it?" drill. Ask your chosen agent to find 3 things without your help: your financial POA, your long-term care policy number, and the account that will fund a deposit. Start a timer. If they can't do it in under 15 minutes, Your plan is invisible. Improve your labels, simplify your binder sections, and rename digital files clearly. Repeat the drill with your backup agent next week. You'll instantly see where to fix. Let me give you a quick micro story. A family new dad had a long-term care policy, but not the carrier. The hospital pushed for discharge to rehab by Friday. The facility required a deposit or policy verification to admit that day. No one could find the policy. The family paid private for 2 weeks while the agent backtracked through old bank statements to discover the carrier. Benefits eventually kicked in, but the private pay gap was over $8,000, money that could have stayed in Dad's care fund. The policy wasn't the problem. The invisibility was. Common mistakes to avoid: keeping documents in a safe deposit box no one can access without you, password lists on sticky notes, but no master system, putting the only copy of the POA in your attorney's office without giving agents a scanned copy, storing everything digitally but not setting up emergency access, and naming accounts cryptically, so even you can't remember where cash lives. Another big one: not confirming that institutions will talk to your agent. Put POAs on file now and note acceptance. Quick wins you can do today. Create a one-page funds fast sheet that lists 2 accounts with enough balance and the exact steps to move money. Put your long-term care policy number and claims phone number at the top of the insurance section. Turn on premium autopay for critical policies so you never lapse during a hospital stay. In your password manager, tag all financial and insurance logins with emergency so your agent can filter quickly. Maintenance keeps it alive. Pick an annual review month, your birthday works, and run a 30-minute refresh. Confirm beneficiaries, scan new policy letters, check autopays, and test 2-factor codes. After any change, text your agents. Binder updated. Digital vault updated. Same locations. Short, simple, done. Here's your script to reduce awkwardness. I'm not handing over my life. I'm handing you a map so you can help under pressure. That line keeps your boundaries intact while making access practical. Share location, not every detail. Your agents don't need balances day to day. They need the ability to act in a crisis. If you remember nothing else, remember this: a plan that can't be found is a plan that won't be used. Build the binder, mirror it in a digital vault, set emergency access, and run the 15-minute drill. You'll turn chaos into a checklist and keep care money working for you instead of leaking out in delays and private pay gaps. The housing promise that traps everyone. I'll never move. Those 3 words feel loving and loyal, but they trap families into crisis moves at premium prices. When housing isn't planned, the timeline gets chosen by a fall, a hospitalization, or caregiver burnout, not by you. And crisis timing is expensive. Higher community rates, fewer choices, and fees to hold rooms you're not ready to use. Let's swap the promise for a plan that protects money and relationships. Here's why this matters. Care needs rarely stay still. Independent living can shift to assisted living, then to memory care or skilled nursing. If you've promised to stay home, no matter what, you're blocking waitlists, delaying home safety upgrades, and denying the reality that care levels change. Families end up paying top of market for immediate placement because they skipped early planning. Meanwhile, the house sits unsold, equity is locked, and cash flow is tight right when deposits are due. The thing most people miss is the hidden cost of waiting. Good communities often have wait lists months long. Entering on your terms lets you choose the right fit, negotiate move-in offers, and sell the house in season instead of dumping it under pressure. Staying home safely can work, but it takes real investment. Grab bars, lighting, stair solutions, bath modifications, and backup caregivers. Without those, the Never Move pledge increases fall risk and burns out the child who's just helping. There's a better method. Plan A, Plan B, Plan C. Plan A is age in place with safety upgrades and part-time help. Plan B is right-sized living, like independent or assisted living with supports. Plan C is higher care, such as memory care or skilled nursing if needed. Each plan needs timing windows, what triggers a shift, and a money map, how you fund it. When you have 3 plans, you're not breaking a promise. You're choosing the right promise for your future self at the right time. Let's build plan properly. Start with a home safety assessment. Many communities or aging-in-place specialists offer them. Fix lighting, remove trip hazards, add grab bars, raise toilet seats, convert tubs to walk-in showers, or add sturdy transfer benches, and consider railings on both sides of stairs. Evaluate entry. If there are steps, explore a modular ramp or a threshold ramp at minimum. Look at bedroom location. Moving sleep to the main level can buy years of safety. Pair this with tech, medication reminders, a fall detection device, and motion-sensing night lights. Layer in support, even 2 to 3 hours a day of help for meals, bathing, and housekeeping can prevent burnout and extend independence. Build a bench of caregivers. Agency plus a couple of trusted private helpers, so a single call-out doesn't trigger a crisis. Schedule respite days for your primary family helper. If your budget is tight, target the high-risk tasks first: bathing, transfers, and nighttime check-ins. Now Plan B, get on wait lists early. You can tour quietly, pay a small, refundable deposit, and hold your place without moving tomorrow. Ask each community about level of care increases, how they price additional support, and whether they require a nurse assessment before move-in. Learn what documentation they need for admission and deposits. Use that knowledge to create your funds fast step for a housing move, which account pays the community deposit within 24 to 72 hours if a great unit opens. Plan C is the if we need it safety net. Identify 2 to 3 higher care options you'd consider. Understand their costs, what insurance covers, and whether they accept Medicaid after a private pay period if that's part of your strategy. Knowing this upfront reduces panic if memory changes or mobility declines faster than expected. Here's your budget model, simple and powerful. Create 3 tiers. Tier 1, age in place. Include housing costs, utilities, food, transportation, meds, insurance, plus paid help hours, and home modifications spread over time. Tier 2, community living. Include base rent, care package levels, meal plans, and add-ons like medication management. Tier 3, higher care. Use local averages for memory care or skilled nursing. Note what's private pay versus potential benefits. Add a 15% buffer to each tier for surprises. Then map your assets to the tier timelines. If Tier 2 for 2 years is likely, can the house sale fund that without fire sale pricing? If yes, great. If not, consider downsizing earlier while you can control the sale. Let's talk about the emotional promise. The better script is, we're exploring options before a crisis chooses for us. That line keeps love intact while opening doors. If a child tries to lock you into, "You promised you'd never move," respond with, "I promised I'd keep my independence and protect our relationships." Having options is how I keep that promise. A quick micro story. A couple delayed moving just 1 more year. Then came a fall, a rehab stay, and a sudden need for assisted living. Their preferred community had a wait list. They took an available room at a different place at top of market rates, paid an admission fee, and rushed to list their home in the slow season. Because the house wasn't ready, they took a price cut, and bridge costs piled up. The same move done 6 months earlier would have saved thousands and given them choice. Now, the practical steps to lock this down. Step 1. Book 2 tours this month, 1 independent/assisted, 1 memory care if there's any concern about cognition. Step 2. Schedule a home safety assessment and fix the top 5 risks. Step 3. Create a downsizing timeline draft, what gets donated, sold, or stored, and who helps. Step 4. Add a housing tab to your family binder, preferred communities, contacts, deposit requirements, and your funds fast plan for move-in. If you want to test your readiness, use the 30-day trial concept. Many communities offer short stays. Try one while you still have energy to evaluate. You'll learn quickly whether the culture, food, activities, and healthcare support fit your style. If it's not a match, you'll know before you need it. Common mistakes to avoid: promising the house to multiple kids while also planning to sell for care, skipping wait lists because we're not ready, underestimating nighttime risks at home, assuming friends can provide consistent care indefinitely, and treating community pricing like a sticker. Often there's flexibility on move-in incentives, not on care fees. Another trap is ignoring transportation. If driving is marginal, plan rides now so isolation doesn't speed decline. Your quick win today: write down your 3 triggers that mean it's time to consider Plan B. Examples: 2 falls in 6 months, increasing confusion with meds, or your caregiver's health changes. Share those with your agent and backup. Decisions feel less like broken promises and more like following agreed rules. If you remember nothing else, remember this: never move is a feeling, not a plan. A, B, and C give you control. Safety upgrades buy time. Waitlists by choice. A clear budget buys peace. Use the line, "We're exploring options before a crisis chooses for us," and you'll keep your independence and your care money intact. Implementation blueprint: from secrets to systems. Let's turn everything you've learned into a simple, repeatable system you can set up in 1 week and maintain in 1 hour a year. The goal is fewer emergencies, fewer arguments, and more money left for your care. We'll do this with a quick audit, a short priority list, the right pros, a family policy, and a maintenance rhythm that runs on autopilot. Start with the quick audit. Grab a notepad or open a clean document. Make 6 headings: accounts, beneficiaries, titles, POAs, loans/gifts, access. Under accounts, list every bank, credit union, and investment account. Note owner names, whether it's joint or single, and the presence of POD/TOD. Under beneficiaries, list each retirement account, annuity, and life policy with current primary and contingent beneficiaries. Under titles, write your home deed style, car titles, and any CDs. Under POAs, list your financial and healthcare POAs, HIPAA, and living will status with dates. Under loans/gifts, summarize any transfers to family in the last 5 years and whether documents exist. Under access, write where documents live, who has copies, and how to move money fast. Now prioritize risks using a simple rule. Fix the issues that blow up eligibility or disinherit people first. So your order is joint accounts, POA gaps, and beneficiary errors. After those, address titles, loans and gifts documentation, tax timing, and housing planning. Put a star next to anything touching those first 3. Those are your week 1 targets. Bring in the right pros, but use them efficiently. An elder law attorney tunes documents to state law, drafts durable POAs, advanced directives, caregiver agreements, and can outline Medicaid look-back implications for past transfers. A fiduciary advisor, or CFP, coordinates drawdown strategy, beneficiary alignment, and account titling. A CPA maps tax timing, RMDs, IRMAA guardrails, and QCDs if you give to charity. The sequence matters. Attorney first for legal structure and compliance. Advisor for asset alignment to the plan. CPA to optimize the year-by-year tax flow. 160 to 90-minute meeting with each can save far more than their fees. Create your family policy to reduce tension. Decide what's shared and what's private. Here's a clean template you can read out loud. We'll share the location of documents, the names of agents, the process to fund deposits, and the rules for caregiver pay. We won't share balances, estate distributions, or running commentary on daily spending. Add your documentation habits. Every gift or loan is written. Caregiving is under contract, at market rate. Transfers use clear memos. This policy protects your privacy while giving your agents what they need to act quickly. Build your binder and vault together, so access is instant. Front pocket. The one-page emergency sheet with agent names, doctors, medications, and the fund's fast plan. Section 1. Legal documents, financial POA, healthcare POA, HIPAA, living will or trust summary. Section 2. Beneficiaries, printouts confirming primaries, contingents, and per stirpes elections. Section 3. Accounts, recent statements, POD/TOD confirmations, and a page listing which account supplies deposits. Section 4. Insurance, long-term care policy, life insurance, policy numbers, claims phone numbers, and premium autopay notes. Section 5. Home and titles, deed copy, vehicle titles, TOD deeds, if used, CDs with TOD. Section 6. Loans/gifts, gift memos, promissory notes, caregiver agreements, and timesheets. The digital vault mirrors it with PDFs and a shared emergency access protocol for your agents. Set up your alerts and access controls. For each bank and brokerage, enable two-factor authentication, turn on balance and transaction alerts, and add read-only access for your chosen helper if available. Upload your financial POA to each institution and ask them to annotate your accounts with your agent's name and the acceptance note. For healthcare systems, add your healthcare agent to your portal and ensure the HIPAA release is in your chart. Then test one login and one institution call with your agent present. If it's clunky now, it'll be impossible during a crisis. Here's your 1-week sprint plan, so you're done fast. Day 1, run the audit and star the high-risk items. Day 2, call the elder law attorney, book the earliest appointment, and gather your current POAs and will. Day 3, fix joint accounts, schedule bank appointments to remove unintended co-owners, and add POD. Set read-only access and alerts. Day 4, pull and update all beneficiary forms, set contingents, confirm per stirpes where intended, and get written confirmation. Day 5, sign caregiver agreements or stop undocumented transfers, start timesheets, and adjust payment memos to caregiving. Day 6, assemble the binder and digital vault, load policy numbers, and write your fund's fast sheet. Day 7, test the 15-minute drill with your agent. Update weak spots immediately. Add a maintenance rhythm that runs itself. Choose your annual review month. Your birthday works. In that week, you'll confirm beneficiaries, retest a bank and your healthcare portal, refresh insurance info, and scan any new legal documents. Then do a year-end 30-minute tax check with your CPA or advisor, map RMDs, check IRMAA thresholds for 2 years out, plan QCDs if charitable, and review withdrawal order for next year's big expenses. Set calendar reminders and share them with your agent so nothing slips. Let me give you a quick micro story of the blueprint at work. A couple did the audit, stripped a quiet joint account, added POD, updated a missed contingent on a large IRA, and signed fresh state-compliant POAs. They created a caregiver agreement for their daughter, who had been helping informally, and started timesheets. 3 months later, a hospital discharge forced a fast move to assisted living. Their agent pulled the binder, used the fund's fast plan to wire the deposit the same day, and submitted the long-term care policy claim with the policy number at hand. No private pay gap, no scramble, no sibling fight. The siblings thanked each other instead of blaming. Common pitfalls to avoid: rushing title changes without understanding survivorship effects, skipping contingents, assuming banks will accept any POA, leaving minors named directly on accounts, paying caregivers in cash with no logs, and creating a binder that only you can navigate. If a 15-minute drill fails, the system isn't done. Your final checklist to cement the system: roles clear, documents current, institutions pre-accepted, beneficiaries verified, titles aligned, caregiver pay documented, alerts on, funds fast ready, binder built, vault mirrored, drill passed. When each box is checked, your plan stops relying on memory and good luck. It runs on rails. And that's how you keep peace in the family and cash in your care fund, where it belongs. Recap and next steps. Here's the truth in one breath. Boundaries plus paperwork keep families calm and keep care money intact. You stop the joint account landmine, replace verbal promises with simple documents, turned help into legitimate caregiving, updated POAs that institutions accept, cleaned up beneficiaries and titles, pulled money in a tax-smart order, designed fairness, not just equality, made your plan findable, and swapped never move for A, B/C housing options. Now, let's lock this down with a 7-day sprint you can start today. This is the point where most families procrastinate and where small delays become big bills. Don't let that be your story. Day 1, audit. List accounts, beneficiaries, titles, POAs, loans/gifts, and access locations. Circle joint owners, missing contingents, and old POAs. Write funds fast at the top of your list. Day 2, joint accounts. Call the bank, remove unintended co-owners, add pod/TOD, set read-only access and alerts, and confirm two-factor authentication. Day 3, beneficiaries and titles. Pull every policy and account page. Add contingents, persterpes if intended, and fix any minors. Request written confirmations and save PDFs. Day 4, POAs and healthcare docs. Book an elder law appointment. If documents are current, upload to banks, doctors, and portals and verify acceptance. Add HIPAA to charts. Day 5, gifts, loans, and caregiving. Write gift memos, draft promissory notes, and sign a caregiver agreement with market rate pay, logs, and taxes handled. Rename payment memos to caregiving. Day 6, binder and vault. Build sections, load policy numbers, claim contacts, and the funds fast plan. Set emergency access in your password manager. Add your agent's phone for two-factor backups where allowed. Day 7, drill. Ask your agent to find your financial POA, long-term care policy number, and the deposit account in under 15 minutes. Fix anything that slows them down. Use these conversation scripts to stay kind and firm. I'll put that in writing so no one gets blamed later. I'm documenting choices to prevent blame later. Caregiving is real work, so we'll use a simple contract. We'll share where documents are and how to fund a deposit. Balances and distributions stay private. We're exploring options before a crisis chooses for us. Avoid these pitfalls that quietly cost fortunes. Rushed title changes that create survivorship you didn't intend. Skipping contingent beneficiaries and persterpes elections. Paying caregivers in cash without logs or taxes. Pulling big IRA money late in the year and tripping IRMAA. Ignoring wait lists and home safety upgrades. Storing the only plan in a safe deposit box no one can access. Here's your maintenance rhythm. Annual review month. Confirm beneficiaries, retest bank and health portals, scan policy updates, verify autopay, and refresh the fund's fast sheet. Year-end tax check. With your CPA/CFP, plan RMDs, manage brackets, set QCDs if charitable, and map next year's withdrawal order. Quarterly pulse. Update caregiver logs and ensure payment memos say caregiving. Motivation in one line. This work buys peace, speed, and choices when life turns fast. You're not planning for fear, you're planning for control. The earlier you act, the more options you keep, and the fewer fights you'll face. If you want to go deeper on slashing care costs, taxes, and surcharges, your next click should cover benefits, drawdown timing, and eligibility traps with real-world checklists. One sentence to remember: systems beat secrets. Clear roles, clean forms, and fast access protect your money and your relationships. Share this with the one person most likely to help you, so you're not carrying this alone. Your key takeaway: separate ownership, authority, and access, then back it with documents. This prevents conflict and keeps care dollars from leaking to taxes, delays, and lawsuits. For the next step, watch the video on cutting care costs with tax-smart drawdowns, QCDs, and benefits timing. It pairs perfectly with the plan you built here. Subscribe for weekly checklists and share this with the one family member who'll be your backup.